Good day everyone, I am Charina Marie Malacao, and in this video I will be explaining what is accounting cycle and what are the processes of accounting cycle. So accounting cycle is a collective process of identifying and analyzing and recording accounting events of a company. There are 8 processes in accounting cycle which I will explain for the next videos, and I will also provide a supplementary videos for you to further understand the concept of accounting cycle and understand what are the processes of it. So stay tuned and I hope you will learn something in this video. These are the following steps in accounting cycle. The first step is identify transaction. Identifying transactions is the very beginning of the accounting cycle. This is when a transaction takes place in the company or a business. In this step, monitoring and proper record keeping is essential. The next step is record transactions in journal. This is where keeping and recording transactions takes place. It should be in chronological order, and generally it includes date. It also includes the account you're debiting and crediting. And it also has a brief description of the transactions occurred. The next step is the posting. This is where companies summarize the journals by totaling up the debits and credit columns from each journal and transferring it to the general ledger. Next step is the unadjusted trial balance. This is where general ledger balances are transferred to unadjusted trial balance. The goal of this step is to simplify and assure that all debits and credit balances are equal. Is the worksheet. This is where adjusting of entries takes place. In this step, income and expenses accounts are being adjusted so that they can comply with the accrual concept of accounting. The main purpose of this step is to match incomes and expenses to appropriate accounting periods. The next step is the adjusted trial balance is prepared. Adjusted trial balance is a list of the balances of ledger accounts which is created after the preparation of adjusting entries. The step 7 is the financial statements. This is where the adjusted trial balance will be used to create financial statements such as the income statements, the balance sheet, and the statement of cash flows. Last but not the least is the closing of the books. In accounting, the word book refers to a company's record of financial transactions. The term closing the books is where zeroing out their income and expense accounts and then plugging out net profit or net loss into the balance sheet takes place.
An accounting cycle consists of the traditional procedures performed to record business events and transactions in a company's accounting records. The accounting cycle begins when a transaction occurs and finishes when the financial statements are prepared and the books are made ready for the next accounting period. Traditionally, the accounting cycle consisted of 9 steps. 1. Financial data associated with the transaction is collected and analyzed to determine how it should be recorded in the accounting records. 2. The data is entered into the general journal. 3. Entries are posted to the general ledger. 4. An unadjusted trial balance is prepared to make sure total debit balances equal total credit balances. 5. Appropriate adjusting entries such as accrual adjustments and periodic depreciation and amortization are made to the unadjusted trial balance. 6. The adjusted trial balance is prepared. 7. The adjusted trial balance is used to create financial statements such as the income statement, balance sheet, and statement of cash flows. 8. The books are closed. This involves zeroing out the income and expense accounts with the difference going to retained earnings as either income or loss. 9. A post-closing trial balance is prepared to check the accuracy of the closing entries. These steps are considered traditional because they are a holdover from when accounting and bookkeeping was a manual process. Sophisticated accounting software has made many of these steps obsolete.